I will now turn the call over to Stephanie Von Hassel, VP of Investor Relations. You may begin your conference.
Thank you. Good afternoon and welcome, everyone. Today I'm joined by MMEN's co-founder and CEO, Adam Bierman, and Chief Financial Officer, Michael Kremer. On today's call, management will provide prepared remarks, and then we will open the call to your questions. Chief Corporate Development Officer, Zishan Haider, will also be available to answer questions post-call. Earlier today, we issued a press release announcing our results for the fiscal quarter ended March 30th, 2019. The press release, along with our financial statements and MD&A, are available on the company's website and filed on SEDAR. Before we begin, I'd like to remind you that the comments on today's call will include forward-looking statements, which by their nature involve estimates, projections, goals, forecasts, and assumptions, and are subject to risks and uncertainties that could cause actual results or outcomes to differ materially from those expressed in the forward-looking statements. And certain material factors or assumptions were applied in drawing a conclusion or making a forecast in such statements. Forward-looking statements relate to, among other things, the business and operations of MedMen and PharmaCann, our plans for new stores and other facilities, our financial and operational expectations, our expectations as to future sources of funding, the terms, conditions, structuring, and timing for completion of acquisitions, and the prospects of MedMen upon completion of the acquisitions. These forward-looking statements speak only as of the date of this conference call and should not be relied upon as predictions of future events. Additional information about the material factors and assumptions forming the basis of the forward-looking statements and risk factors can be found in MedMen's Annual Information Form dated November 2nd, 2018, the Management Discussion and Analysis for the period ended March 30th, 2019, and the earnings press release issued earlier today, all of which are available under the company's profile on SEDAR. During today's conference call, MedMen will refer to certain non-IFRS measures that do not have any standardized meaning prescribed by IFRS, such as EBITDA and adjusted EBITDA, which are defined in the earnings press release we issued earlier today. Reconciliations to IFRS measures are contained in the press release and our MD&A. Please note, all financial information is provided in US dollars unless otherwise indicated. Now with that, I'd like to turn the call over to Adam.
Good afternoon, everyone, and thanks for joining us today. Exactly 1 year ago, MedMen began trading on the CSE, and what a past year it's been. Through organic growth and acquisitions, we opened 7 retail stores across our core markets of California, Nevada, and New York, and extended our brand with 4 stores in the new markets of Illinois and Arizona. The acceleration of our retail expansion has led to a significant increase in our revenues, which were $36.6 million in the third quarter, a 22% sequential increase over the previous quarter. This does not include an additional $20 million in third quarter revenue that was generated by our pending acquisitions, which would put MedMen at a pro-forma annual run rate of over $225 million. Over the past year, we've created tremendous long-term value for the business, yet we've also had to deal with a few not-so-great realities of managing a high-growth business, such as a well-publicized employee and early investor lawsuit. From an operational standpoint, this company has never been better positioned than it is right now, today. Yet we have a stock price that has underperformed the North American Marijuana Index by over 45% since our all-time high last October. As a U.S. leader in both revenue and brand, this disconnect is our responsibility to reconcile, and our work to do so is well underway. As Michael will discuss later, we have rethought the methodology for reporting our numbers to the street, and I firmly believe, under Michael's leadership, we will improve the communication around our financials and get to a place where there is full transparency around our use of capital, in addition to a focus on our four-wall economics, which continue to outperform. Ultimately, we have 2 key buckets of financial data. In one bucket, we have made investments and allocated capital to position our brand ahead of regulatory catalysts. In the other bucket, there is the standalone performance of our stores, which is the validation of our operational excellence. Ultimately, as the industry moves into a more stabilized place, those 2 buckets will become one. But in the interim, we must explain them individually. For those that are new to the industry and to our story, our strategy is based on 3 core phases or objectives, which have not changed since day one. Our first objective is building the MedMen brand and ecosystem. We have been at this since 2010, with 2015 being the year we really started to capitalize on our first mover advantage by securing flagship retail locations across our Tier 1 markets. This includes locations like Abbot Kinney in Venice, Robertson in Beverly Hills, Fifth Avenue in New York City, Fenway in Boston, and South Beach in Miami. This flagship approach enabled us to build the largest brand in cannabis, having drawn over 1 million customers to date into our stores from all 50 states. Objective 2 has been to increase market share and create an omni-channel experience. Here, we are focused on deeper penetration in core markets like California and replicating our retail concept in support markets. Given our experience running stores across California, we feel confident that our retail operation and brand will be successful in all these other markets. In addition to building out the retail footprint, we will use this time to establish our digital presence through the millions of data points we have collected from our transactions. While growing market share, we are also using this phase to begin our optimization efforts to streamline the organization on a path to profitability. And our third objective is to drive profitability through improved four-wall economics and investments in our supply chain. As we establish our retail footprint in both Tier 1 and support markets, we will look to increase the share of our higher margin private label brands in our stores, maximize our operating leverage to drive four-wall margins, and extend our reach across the supply chain. This has always been our plan. The first phase of our company was defined by taking advantage of the land grab opportunity to build the most valuable cannabis retail footprint in the world. We then entered our next phase, which included our decision to go public to raise capital to further deepen our footprint within our target markets through store openings and acquisitions, moving at a breakneck speed to secure as many flagship assets as possible. And as of our first quarter earnings call in November, I communicated that we are entering a chapter at MMEN, which is now driven by a path to profitability. The biggest driver in our path to profitability will be revenue growth, and with 15 planned new store openings during the remainder of this calendar year alone, you can expect our top line to continue to grow at a very healthy pace. In addition to growing our revenue, we are optimizing the organization for efficiency, including a flattening of layers toward the top of the company and taking a hard look at SG&A across the business. While this is a work in progress, we are targeting a 20% reduction in our run rate SG&A from the end of December. And we are ahead of that plan, having already reduced corporate SG&A by 9%. With the progress we've made, we are optimistic that we can achieve the 20% reduction over the next few quarters. Everyone across the organization has bought into this initiative, and as part of this commitment, Andrew and I have entered into new employment agreements, taking the California state minimum $50,000 in annual salaries, while the strike prices of our unvesting equity remains unchanged, with CAD $10, $15, and $20 share price hurdles. Ben Rose, our chairman, has played a vital role in all our progress, with a substantial focus on corporate governance and strengthening the support available to the executive suite. And as a result of his increased participation, he will be stepping into the executive chairman role effective immediately, where he can effect even more progress. As of earlier this year, Ben decided to forego any compensation for his role, and that will continue in his revised capacity. Since joining the board in August 2018, Ben has been a valuable strategist and counselor to the executive team, and in his new role, he will be more actively involved in our day-to-day operations with a particular focus on balancing MMEN's strategic growth with cost-cutting initiatives to advance the company towards profitability. And we look forward to his deeper involvement in the business. Our strategy has been consistent since the beginning, and we are progressing as planned. We've established ourselves as the leading cannabis retailer in the U.S. with the most recognizable brand in the most strategic markets. The next stage of evolution of our business is to grow the retail network and achieve profitability through scale and vertical integration. While cannabis evolves at a much faster pace than other consumer verticals, the outcome will likely be similar. Those that control the consumer touch point and shelf space will be the ultimate winners. We have never been stronger, and now it's on us to deliver this information to the street in an effective manner so we can be evaluated appropriately. I'd like to now turn the call over to Michael.
Thank you, Adam. Let me start off with what most of you will be pleased to hear. We've been hard at work to deliver on what I previously stated when I joined MMEN back in December. Spanning the company's operations in California, Nevada, New York, Arizona, and Illinois, system-wide revenue was $36.6 million for our fiscal third quarter, ending March 30th. This represents a 22.3% sequential increase from our fiscal 2019 second quarter ended December 29th, 2018. On a pro-forma basis, with pending acquisitions, including the transaction with PharmaCann, revenue for the fiscal third quarter would have been approximately $57 million, equating to an annual run rate of over $225 million. We continue to see growing ROI on our early investments we made in Tier 1 real estate and marketing. As Adam mentioned, the first phase for MMEN has been about scaling as fast as possible to capture market share. Every disruptive business goes through this phase. I saw this firsthand at Apple, and you've seen other companies such as Airbnb and Amazon apply a similar strategy in markets in which early market share, even at the expense of efficiency, leads to outsized returns. Even more so than other companies, consumers are really being forced to purchase at regulated retail establishments, and flagship retail locations in the most important markets are not as readily available to second movers. Over the past 3 years, MMEN has applied a similar strategy, and now we must do so efficiently, starting with SG&A. On the previous call, I announced an SG&A freeze, which was instituted towards the end of fiscal Q3. I view Q3 as our stabilization quarter, a quarter in which we completed a full review of each department. A year ago, we prioritized speed over cost in order to achieve our growth objectives. This was happening across the board, from build-out costs to marketing spend to hiring. We understand we are in a different place today, and we've made significant changes to the expense and capital approval process. All expenses go through a rigorous approval process that ends with me. While this has forced us to make tough decisions and can be laborious at times, we have full buy-in behind this new phase as we now view everything through an ROI-driven lens. While our internal goal was to keep SG&A flat, we were able to decrease corporate SG&A by 9% quarter to quarter. Our streamlining efforts will be fully reflected in the coming quarters, during which we expect a further double-digit decline to achieve our 20% target. We continue to extensively review and reassess our current processes while creating greater efficiencies across the board. I will expand on these metrics shortly, but before digging in, I'd like to touch on a few operational highlights from the quarter. First, we expanded our California footprint to Northern California by closing the acquisitions of 2 retailers, one in San Jose and the other in Seaside. Northern California remains a significant opportunity for growth for MMEN. We also closed the acquisition of Level Up, which had 2 vertically integrated operations in Arizona, including retail locations in Scottsdale and Tempe. Given the growth trajectory of the Arizona cannabis market and the overlap in tourism between California and Arizona, we remain excited about the potential for continued growth within the state. Also during the quarter, our Paradise location in Las Vegas, the closest dispensary to the airport, has now become the second highest performing store in the MMEN portfolio within 6 months of being operational. This demonstrates our ability to successfully extend the MMEN ecosystem into new markets, especially tourist-heavy ones in which our brand is already recognized. As I mentioned, through an ongoing reorganization of the company, we reduced corporate SG&A by 9% sequentially, with line of sight to an additional reduction in the next quarter to achieve our 20% reduction target. We completed the sale of 3 storefront properties and 2 cultivation factories to Treehouse Real Estate Investment Trust, with gross proceeds of approximately $72 million. As a reminder, the Treehouse REIT expects to fund future factory build-outs, thereby eliminating more than $150 million in planned CapEx for us over the next 2 years. Finally, During the quarter, we announced a $250 million convertible financing with Gotham Green Partners, one of the most strategic and value-add partners in the cannabis industry. As of last week, we have closed on a total of $100 million. The financing allows us to ramp up our store openings and provide the working capital necessary to fund the balance of our assets. Now, let's dig into all 4 business units: retail operations, cultivation and manufacturing, corporate SG&A, and pre-opening expenses. Starting with retail highlights. Retail revenue totaled $34.6 million, representing a 16% sequential increase over the last quarter. Revenue is based on the 21 retail stores that were operational at the end of the quarter. Sequentially, sales are up due to 2 key drivers. First, despite the usual downward traffic that retailers typically experience in the quarter after the holiday season, we saw positive same-store sales growth during the quarter. Based on the quarter-to-date results, we expect high single-digit same-store sales growth in the fourth quarter. Secondly, a portion of the sequential sales growth was related to the closing acquisitions, which were Buddy's and Seaside, both in California, Level Up in Arizona, and 7 Point in Illinois. They were all closed during the quarter. Please note that only partial revenue for these stores were included. The full amount will be reflected in the next quarter. In terms of retail gross margins, we recorded 53% gross margins for the quarter, which is up slightly from the previous quarter. The key drivers of margin enhancement were, first, our increased leverage over suppliers that has allowed us to negotiate best-in-class pricing from our partner brands. We have a rigorous onboarding process for new products in our stores. Not only are we expecting outsized sell-through, but we are targeting gross margins of 55% plus for all new products. The second driver of increased margins is our continued product shift to higher margin products such as edibles and vape pens. On an EBITDA basis, our retail margin across all markets declined from 16.6% to 12.5%. There are a few factors that led to this decline. First was the closing of transactions in medical markets such as Arizona and Illinois. In these medical markets, we typically see lower EBITDA margins at the store level given volume and pricing dynamics. While overall margins improve from a vertical integration in medical markets, this won't be reflected at the store level. And second, an increase in labor costs related to the unionization of employees in several of our stores. While we will experience an increased short-term negative impact, we believe the increased wages and benefits will allow us to reduce employee turnover and allow us to offer a more consistent experience to our customers. Let's now dig into some of our core markets. California. California remains the majority of our business today with our 10 retail locations in California, reporting a combined $24.9 million in revenue. Note that out of these 10 retail locations, Seaside and Buddy's, which are now included in these figures, contributed only partially as the acquisitions closed mid-quarter. The full revenue was included, however, in the Pro-Forma numbers. We expect to see stronger contributions from these locations in the following quarters. Given these results, we continue to target a store average of $20 million in revenue in mature markets, which we believe is attainable given, 1, a continued shutdown of illegal stores within the state, 2, the overall mainstreaming of cannabis, which continues to bring in new consumers, and 3, the overall shift towards value-added products such as edibles and extracts. At these revenue numbers, the return on capital for an investment in a flagship store in California is unmatched in the retail universe. There is significant IRR embedded in these stores, which cost on average $2 million to build and have the potential to produce EBITDA margins north of 30%. In an effort to reduce costs, we will be partnering with a third party, ADMI, a leader in retail development, design, and construction, known for developing the Apple stores and Sony stores. As we integrate ADMI, we expect to see even higher IRRs and faster payback given the planned reduction in build-out costs. While most of our stores are still ramping up and we typically see a 9 to 12 month ramp-up period or undergoing expansions, we are seeing continued improvements month over month for all of our locations. We expanded our Beverly Hills retail location towards the end of calendar 2018, and we are in the process of expanding our Abbott Kinney location. Our retail operations team has also been doing a great job on improving store-level margins. Retail gross margins in California, which improved to 57% from 51% in the previous quarter, continue to increase given the increased leverage we now have over suppliers and distributors. We estimate that the pricing we receive in our stores is 20 to 30% more favorable than the average dispensary given our scale and influence. For California, in particular, four-wall EBITDA margins were 22% for the quarter. For our California stores, we are purchasing all of our product from third-party manufacturers and distributors, which highlights the opportunities to significantly enhance margins company-wide once our factory can start producing our own in-house products. The ultimate goal is to have 50% penetration for our in-house brands. Other markets. Moving on from California, we are seeing similar success in other markets. Strong system-wide retail revenue across our portfolio is primarily attributable to MMENS retail expansion in Nevada and Arizona. In Nevada and Arizona, third quarter retail sales increased sequentially 34% and 513% respectively. While most of this growth is through M&A, we are up organically as well. In Arizona, the increase was driven by the addition of stores in Scottsdale and Tempe. In Nevada, MMEN's Paradise location, the closest dispensary to McCarran Airport, is now our second highest performing store, with a 39% increase over the previous quarter. While Nevada and Arizona continue to drive growth for the company, our highest priority non-California market from a retail perspective is Florida. Florida represents a potential $1 billion plus medical-only market and $3 billion plus recreational market, with a demographic profile and tourist flow that is ideal for cannabis. We remain on track to open 12 additional locations in Florida, including the South Beach, Miami Beach, Orlando, and Key West during calendar 2019. Similar to the zoning restriction dynamics in other markets, planting flags in marquee locations allows us to create significant buffers around our stores, preventing competition. Keep in mind that opening up stores in Florida, particularly in the locations we've been able to secure, is capital intensive. But similar to California, we believe there is substantial long-term value embedded in these stores. Even under the medical scenario, and assuming an average build-out cost of $2 million per store, we project a payback period of 2 to 3 years, and IRRs far above our cost of capital. Under a recreational scenario, our payback on a store would be 6 to 12 months, and IRRs of at least 50%, which is in line with our mature California locations. When we first acquired our Florida license, we were pleasantly surprised at the type of retail locations that were available from a real estate perspective, given the focus on medical for the early operators. While we are looking forward to serving the medical patient base in Florida, which recently surpassed 200,000 patients, we are thrilled at the prospect of building our brand through flagship retail ahead of the potential shift towards adult use. And lastly, a quick note on Massachusetts. During the quarter, we received local approval on our Fenway Park location in Boston, which is located very close to the ballpark where the Red Sox play. Highlighting the difficulty of securing these types of flagship opportunities, our real estate team spent over a year getting the entitlements and local approval for this location. We are continuing to go through the permitting process and expect the store to be open in early calendar 2020. Given the strategic location of the store, we expect this store to become one of the highest performing dispensaries both in the state and in our portfolio. Cultivation and manufacturing. We continue to invest in our supply chain for our in-house brands, which we are rolling out across each of our markets based on the capacity of our factories. Controlling the supply chain by building our own cultivation and manufacturing factories is essential to producing consistent products and enhancing overall margins. We reported revenue of $2 million and a $4.7 million EBITDA loss for cultivation and manufacturing during the quarter. Approximately $4.3 million is related to costs associated with Project Mustang in Nevada, which is still in the process of scaling. These costs were expected during the ramp-up period, and we expect to achieve break-even by the end of the calendar year. While retail is our core business, we believe that producing our own products allows us to, first, increase margins significantly. We've estimated gross margins of 80% plus when we manufacture ourselves. And second, offer customers more bespoke products based on the data we are collecting on consumer preferences. Our first brand launch was State Made in the Nevada market, and we are currently rolling that brand out across our entire footprint. We recently launched our value-oriented MMEN Red line, which was tested in our Las Vegas stores. The line of vape pens already represent 14% of total vape pen sales in our stores, further illustrating the trust and loyalty that consumers have for the MMEN retail brand. This brand will be the next to roll out across our footprint. Outside of Nevada, our second full-scale factory, located in Desert Hot Springs in California, has completed construction and received the regulatory approvals to commence operations. We expect output from our Desert Hot Springs factory to be in line with that of Project Mustang. Now let's move on to our third business unit for reporting purposes, corporate SG&A. As I mentioned earlier, we instituted an SG&A freeze towards the end of the quarter, allowing us to conduct a thorough review of all of our expenses. The bulk of the SG&A declines will be reflected in the fourth quarter, yet we were still able to see a 9% sequential reduction. Corporate SG&A EBITDA loss for the quarter was $37.5 million, compared to $40.9 million in the previous quarter. The key driver of this improvement was decreased marketing, legal, and human resources. Given recent initiatives since the quarter end, we expect SG&A expenses to decline further over the next couple quarters, and expect most of the savings to come from the reduction of corporate-level payroll by more than $8 million on an annual basis. In addition to flattening the organization, we're also in the process of adjusting compensation packages for existing managers to be even more P&L and performance-based. Of the total $37.5 million in SG&A expenses, the largest line item is marketing, which was $7.8 million for the quarter. Outside of marketing, the other large drivers of spend were G&A at $6.4 million, security costs of $3.1 million, and IT spend of $3.3 million. IT spend includes our in-house digital and delivery teams, which are hard at work rolling out a loyalty and delivery platform. I would also like to point out that as an industry becomes more mainstream, several cost items will naturally come down given the cannabis premium operators today are forced to pay. These include items like insurance, security, and payment processing, which are completely out of line with market rates. The last business unit we are breaking out is pre-opening expenses. We incurred $4.6 million of pre-opening expenses in Q3, primarily driven by rent expenses of retail stores, cultivation, manufacturing sites, and facilities that are not yet operational. This is up from $3 million in the previous quarter. These expenses will be incurred as we sign leases in new locations, and we view them as first-mover investments to secure valuable real estate in advance of us being able to generate strong IRRs once operational. In summary, on a consolidated basis, we reported gross revenue of $36.6 million, which was up 22% over the previous quarter and up 156% over the fiscal third quarter of last year. Gross profit margin in the third quarter, after biological asset adjustment, was 53.7%, compared with 53.2% in the previous quarter. Given the scale of our operations and the increasing leverage we hold over our suppliers, we are confident in our ability to enhance gross margins over time, as we've already seen in California. We recorded a non-cash $9.8 million unrealized gain on the fair value of biological assets in the third quarter related to our cultivation operation. The adjustment is not applicable under U.S. GAAP accounting, but is required under IFRS. Given the inherent subjectivity of this data point, we do not consider this measurement to be a driving factor in the assessment of our business. We will continue to report it as required, but we don't take it into consideration as we manage our day-to-day business. While we discussed the primary drivers of expenses by business unit, it is important to note that also included in the third quarter operating costs was $5.4 million of cash and non-cash stock compensation and employee incentive plans, compared to $12.1 million in the previous quarter. $3.4 million for acquisition-related expenses compared to $5.4 million in the previous quarter, and $6.9 million for state, local, and federal taxes compared to $5.3 million in the previous quarter. Financing costs were $6.8 million for the quarter versus $0.6 million in the previous quarter. Overall, we reported a net loss of $63.1 million in the third quarter, or 20-cent loss per basic and diluted share attributable to MMEN Enterprises shareholders, based on our weighted average shares outstanding of 118.9 million, the public float as of March 30th. It's important to note that the exercise of our convertible debt, long-term incentive plans, share units, warrants, and share options are anti-dilutive. This compares to a net loss of $64.6 million in the previous quarter and a 25% loss per basic and diluted share attributable to MMEN Enterprise shareholders, based on the weighted average shares outstanding of 74.2 million. Moving on to the balance sheet. We've significantly enhanced our cash position through our most recent transaction with Gotham Green Partners. Gotham Green committed up to $250 million in convertible financing to MMEN, which would be drawn down in 3 tranches. The first tranche of $100 million has already been funded. The remaining 2 $75 million tranches will be drawn down at the company's options starting at the 6-month and 12-month anniversary, respectively, of the closing last week, subject to certain stock price hurdles being achieved. Please note that the $25 million of the second $75 million tranche can be called starting at approximately 3 months after the initial closing in April, without a stock price hurdle. We are excited to work with Gotham Green Partners in our growth initiatives and believe there are a number of areas of the industry where we can partner with them. A big focus for my team is to provide the shareholder and analyst community more details around capital allocation and cash needs, as well as steps we are taking to drive efficiencies around this. For the third quarter, our overall net cash use was $56.3 million. Our net cash used for operating activities was $59.2 million. Our investing activities resulted in a net increase of $27.5 million, mainly as a result of the $72.3 million of cash proceeds received from the sale of real estate. Included in the net cash figure for investing activities was $26.9 million of cash used for CapEx and $18.5 million of cash used for M&A payments. Lastly, our financing activities result in a net cash decrease of $24.6 million, mainly attributable to the payoff of debt related to our real estate. I view cash needs in 3 main buckets. First bucket, corporate SG&A. I spoke at length earlier about cost savings initiatives to run the business more efficiently. This includes a flattening of the organization at the corporate level, which will result in close to $8 million in annualized payroll being eliminated. This also includes eliminating spend that has lower ROI today than it did a year ago. To reiterate, we are planning for a 20% overall reduction in corporate SG&A from the previous quarter. While we have demonstrated our ability to enhance margins at the retail, increasing manufacturing capacity and rolling out our in-house products should have significant impacts on overall profitability. Second bucket, CapEx. MMEN has historically invested a significant amount of cash in acquiring and developing real estate for both its retail and cultivation operations. While this has allowed MMEN to create a unique footprint, owning more than $100 million of real estate is not the most accretive use of capital for a cannabis company. Through sales to Treehouse REIT to date, MMEN netted over $50 million of cash and eliminated over $150 million of CapEx needs over the next 2 years. In addition to Treehouse REIT, we've begun to outsource the construction management of our retail stores to ADMI, who I personally worked with at Apple, As I mentioned earlier, ADMI will allow us to open source faster and more inexpensive. Third and last bucket, operationalizing our footprint. Given the margin profile of our stores, opening stores and generating positive EBITDA from those stores will have a significant impact on overall cash burn. As mentioned earlier, we feel confident in our ability to enhance margins even further through increased gross margin, payroll optimization, and lower marketing expense. In addition to opening the balance of our stores, bringing our factories to full capacity will also have a significant impact on our cash outflows. Lastly, a brief update on M&A. We are working closely with regulators on closing our PharmaCann acquisition. While there is no definitive timeline, we expect a closing in fiscal Q2 of 2020. We are excited about the continued progress of PharmaCann's operations and the accretive nature of the transaction to our shareholders. Please note that we intend to file on SEDAR first quarter 2019 interim financial statements for PharmaCann next week, in part to satisfy the requirements for our ATM offering program. Outside of PharmaCann, we remain focused on leveraging our M&A capabilities to get deeper in our core markets. Our M&A pipeline is filled with a number of highly accretive bolt-on deals in the 1 to 2 times revenue range, which have projected IRRs significantly higher than our cost of capital. As always, we are focused on acquiring well-positioned retailers and are unlikely to allocate capital to overpay for brands and distributors with limited defensibility. In summary, we are able to grow our revenue by 22% quarter over quarter, decrease our corporate SG&A by 9% quarter over quarter, with a clear line of sight to achieve our targeted 20% reduction. And we received a commitment from Gotham Green Partners for up to $250 million to fund the balance of our assets. I could not be more excited about the prospects of our business going forward. Now with that, we can open up the call to your questions.
At this time, I would like to remind everyone, in order to ask a question, press star 1 on your telephone keypad. To withdraw your question, press the pound key. We will pause for a moment to compile the Q&A roster. Your first question comes from Graham Kreindler from 8 Capital.
Yeah, hi, good evening, and thanks for taking my questions here. Just a couple of housekeeping items here, I guess to clarify with Michael. With respect to the 20% decrease targeted on the SG&A, so is that a 20% sequential decrease quarter over quarter? Is that the way to think about it?
20% from the quarter, the run rate of the quarter ended December, Q2.
Okay, from Q2, gotcha. And then on the PharmaCann closing, so with respect to the timeline on fiscal Q2 2020, I guess that puts you relatively in line with the initial timeline for closing from when the deal is announced. Is it more of a state regulators getting through to each one of those at this point in time, or are there other approvals required? What remains the sticky?
Hey Graham, good question. This is Zishan. So it's a twofold kind of process. One, we are getting approval by the states on the transfer of those licenses. It's also undergoing kind of the standard HSR antitrust review. And that's kind of the timeline that we expect for both of those to be approved.
Okay, thanks. And then the other thing before I jump back into the queue for Adam here, at the beginning of the call, you mentioned what you were talking about in terms of a disconnect in the share price of MMEN and the underlying assets. And I think you discussed about the revenue growth of the business, obviously disclosing on a pro-forma basis quarter over quarter, but just wanted to get a bit more color in terms of what steps you think in the near to medium term you think are most important in terms of communicating those differences and ultimately reconciling.
Yeah, I know this was direct towards Adam, but if you don't mind, I know you're tired of hearing my voice, but this is Kramer. I'll go ahead and answer that because I think this is an incredibly important question. We're continuing to work hard to provide to the investment community and stakeholders, better understanding of our business. we're hopeful that you guys are seeing the progress in terms of the information that we're providing you all the way from last quarter through this quarter, and hopefully, it's been helpful. Here's what I know. I know that retail brands such as ours, are traded on two major factors. One is, operational scalability / performance, and the other one is brand value, brand recognition. The companies that trade at premiums to their peers are either the industry leader in the operation or the scalability or the numbers, or an industry leader in brand recognition or brand value. Seldom or uniquely is it's the same company, but when that does happen, there's usually a significant premium to their peers. Here's the reality. The reality is we are a leader in operational scalability in the numbers. And I don't think anybody can doubt that we are the leader in brand recognition. What I'll say personally is that, I've been here almost 5 months, and I've, working here every day. What I can tell you is the talent here is extraordinary. The passion is fierce. And not to mention the fact that we have the best assets in the business. The majority of those, or a lot of those, have great defensible posture. So you combine all that, we're going to continue to put our heads down. We're going to execute to our best abilities. And, the market will get efficient. It always does. My last comment on this is, in all caps, we're just getting started.
Okay, appreciate that. Thanks. I'll jump back in the queue.
Your next question comes from Brett Hundley from Seaport Global.
Hey, good afternoon, guys, and thanks for taking my questions. I just have a couple questions on California to start. So I was actually by your Abbott Kinney store the other day and continued to see the renovations there. Do you have an update on when that location might be finished with its renovations?
Hey, it's Adam. We'll expect to open that in its full form sometime within the next 45 days.
Okay. Thank you for that. And then, Kramer, I think you mentioned that you expect high single-digit same-store sales growth in Q4 for the California business. You can just confirm that for me. And then just as far as trends in that market go, California's been in the news, continuously here year to date with the government talking about, struggling relative to initial tax revenue expectations. And I think you also called out the illicit market and how that's been impacting the overall cannabis marketplace in California. We've also seen some numbers around medical patient numbers where they seem to be moving higher. Just given your stance in California and your leadership position there, can you just talk a little bit to the flow of that market as you see it and your expectations around, the local government clamping down on the illicit market?
Yeah, this is Kramer. I'll answer the first part of that question. As of today for Q4, we are seeing quarter-over-quarter revenues up 20%. Now, on a comp basis, we're seeing 9%. Now, that includes all of our markets. The majority, obviously the majority of that is California. California is accretive to that number. But that's what we're reporting in terms of on a quarter-to-date basis in Q4. Adam's going to answer the remainder of that question.
Yeah, sure. So like a lot of news, you gotta dig a little deeper than the headlines. California today, is the best market for legal cannabis in the country from a business perspective. That is undoubted. That being said, there is so much upside left in California. To your point, the state of California and the local municipalities have not been effective yet in shutting down the illegal operators. my best guess is we are outnumbered legal to illegal operators in Los Angeles at 5 to 1. Still, so a lot of upside there, and that's true kind of throughout the state. The other thing that's really been fascinating as we're tracking all the numbers is, I remember when Colorado finished its first year of legal cannabis, the number was somewhere around 11% of adults in that state, used cannabis or bought cannabis legally. The numbers are coming in California, and over the first year of recreational sales, that number is north of 15%. So I think that California as a market, the upside is embedded in, one, the illegals getting shut down, but two, I just think that people that live in the state of California just have a higher proclivity towards accessing cannabis as an alternative, and we're already seeing that a year and a half post-recreational sales beginning. So there's a lot of work to be done in California, but it's all upside for us. So the way we look at it is, let's just perform under these current circumstances, and as those catalysts, take place to give us even more opportunity, we'll take advantage.
I appreciate that. That 5 to 1 ratio in LA is insane. Just one last question for me in California, and then I'll yield the floor, is for either of you guys, as you guys have become bigger in California and continue to expand your reach and your presence there, Kramer, I don't think I heard you talk to this, but are there efficiencies or optimization opportunities, even at this stage of the game, early on in the cannabis life cycle here? Are there efficiency or optimization opportunities as you become bigger in that state, or should we just not expect that at this point yet?
I think that there's an extreme amount of optimization that continue to perform for us here. I'll give you an example. We are just getting ready to open up a distribution center in LA that will feed all of our stores. So why is this incredibly important? Well, it's incredibly important because we are going to be able to now manage the inventory receipts to our stores. Prior to this, we were relying on our supplier or vendor base to provide the products to our stores. And in a lot of cases, we have small suppliers. They may end up saying, hey, we're going to have your product to you on Thursday. It doesn't show up Thursday, it shows up Friday. So it really has cost us a lot. That's happened more often than not. So it's cost us a lot of out of stocks, even though our out of stock position continually gets better and better and better. But when we open up Porter, we're going to be able to really control the inventory flow into our stores and hopefully dilute the out of stocks to almost nothing. In addition to that, just like anything, in terms of the fill out of any particular market, as we continue to do in San Diego, there's going to be real efficiencies gained in terms of marketing expense and the marketing awareness as we utilize that. On top of that, there's just as you continue to penetrate a market, you're going to be able to leverage everything from your retail management structure to even, we have a lot of opportunity even in our existing stores in terms of managing our payroll, optimizing our payroll in our stores. I'm really excited because, we're starting to really take a deep look. We've always taken a deep look, but we've got a really good pipeline in terms of acquisitions and or new stores in Northern California, which is going to really, crystallize our ownership of California.
Very good. Thank you, Michael.
Your next question comes from Matt Bottomley from Canaccord Genuity.
Thanks for taking the questions, and good afternoon. Just wanted to go back to PharmaCann and wondering if you can provide a couple areas of color if possible. One is, I assume, at least half or a majority of the Pro-Forma adjustment on revenue is coming from PharmaCann. It looks like most of their dispensaries are in New York and Illinois, and I'm just wondering if those are the main states to attribute that $20 million to. And the second thing on PharmaCann, I noticed they still have the ability to open up 9 stores in Pennsylvania, but it doesn't look like anything's opened yet. So any color or guidance onto when that market might start becoming accessible to the PharmaCann?
Yeah, so I'll answer the first part of your question on where their revenue is coming from today. So you're right, a lot of it is coming from Illinois and New York. In the New York market, they're one of the biggest wholesalers in that state today. But, you know, on top of those 2 states, they're also driving a lot of the revenue from Massachusetts, where they have one of the few rec stores that are currently open. So I would expect those numbers to continue to go up kind of over the next 12 months. And as it relates to their Pennsylvania plan, I can't speak too much on kind of their operations plans going forward, but there should be a store there open by the end of the calendar year.
Thanks. That's very helpful. And then maybe just more on a housekeeping side of things. You know, as we're well into the next quarter here, it looks like you've opened up another 3 stores, MedMen branded stores, and then and PharmaCann's opened 1, so it's another 4 quarter over quarter. Should we expect much more in June as it comes to new store openings?
Yeah, so I think, you know, for store openings, that sounds right for the June quarter. There's a few other kind of deals that we have in the pipeline that could enable us to open up more stores beyond that. We haven't disclosed any of those deals yet.
But Matt, it's Adam jumping in. You're not accounting for Florida. You know, I think the guidance we provided is we're going to be opening 12 stores in the state of Florida by the end of this calendar year. That's on top of what you just made mention of. There's a new deck that was just published on the investor side of our website, and probably the page of that deck I'm most excited about is the Florida page. I don't have off the top of my head. I'll have somebody pull what page that is for you, Matt, but this is the first time we're actually providing line of sight for the street as to where all these stores in Florida are going to be. Any store that is listed on that page, which is page 26, we have the real estate under control, we have the local license under control, and we are in some phase of build-out. So very excited about Florida, and that's going to take that total store count number between now and the end of the year up significantly from, I think, what you were alluding to.
Much appreciated. Just last question on mine, just going back to that Florida then, and apologies, I don't have that deck open currently, so it might be on there, but I think you said on the call, maybe Kramer, that it's going to be about $2 million to open up each location. Is there any additional estimate you have on top of that for the production cultivation side of things? And then if you could just goalpost how much you think the Florida spend in total might be, you know, for the next 6 months here.
Yeah, well, that $2 million that was quoted in terms of the script, the earlier script, was really an example to really show, you know, the IRR in the California market. What I can tell you is that our target for our CapEx spending in our stores is $250 a square foot. Today we are north of that. But we're well on our way. Again, as you know, I've laid out some of our partnerships with a third party in terms of construction. I've worked with them before. They're going to nail it in terms of cost re-engineering, in terms of meeting timing, so that we're not sitting around with, you know, people that we've hired because of delays. Now, some of this is due to regulations, but we're learning as we go there. But our target again is about $250 a square foot. We've not indicated publicly what our investment in terms of cultivation, manufacturing is.
Okay, that's it for me. Thanks, guys.
Your next question comes from Greg Gibas from Northland Capital.
Good afternoon, guys. Thanks for taking my questions. First, what regions in California do you find to be the most attractive for new expansion in the state as you work your way towards the 30-plus dispensaries in the state over time?
Sure. It's Adam. I'll take it. The way we've looked at the state of California is the epicenter is Los Angeles, and we're very proud of the kind of dominant position we've created for ourselves in LA. And then that's bled into Orange County and down to San Diego. So I would say that, you know, first and foremost, it has to do with OC and San Diego. We have tremendous brand recognition and following in those, those other parts of Southern California, and we have such rich data, that allows us to be, really thoughtful about how we're making these investments and how we're growing. And the data is overwhelming in regards to the fact that, like, people are willing to drive. We have people that drive from San Diego and Orange County to Los Angeles to shop at MedMen. And so that's the natural place to put more stores where people are already yearning for the experience. So I guess that would be the first piece. And then the second piece would be, Northern California is a real market on its own. It's not Southern California, it's not Los Angeles, but it's, a more important market with more opportunity than, I think, the majority of the balance of the states in the country. And so that's how we look at Northern California, and I think, getting to critical mass in Northern California is a very important part of our plan. With San Jose, Emeryville, Seaside already, locked up, either operational or getting operational, I think you can expect us to fill up Northern California on top of that between now and the end of the year as well.
Perfect. That's really helpful. Second for me would be, how has customer feedback been on the State Made brand thus far? And, what are the most popular State Made products right now? And when do you expect own brands in the store to eventually reach that steady state of 50%?
Yeah, hey, this is Zishan. So we're really excited about the progress of State Made to date. We currently sell it in our Nevada market, and we'll be taking State Made to Florida and California by the end of the year. As it relates to our own brand strategy, so our target is to get to that 50-50 mix between kind of owned brands and third-party brands. A big part of that will be State Made and Lux Light and our new MedMen branded kind of line of products. But in addition to that, we're also using the data that we have in our stores to figure out new product lines and brands to launch that kind of target different demographics that come into our retail locations. So, I think, over the next 24 months, we'll kind of get to that 50-50 mix, but we're going to take our time and collect the data and make sure that we're coming out with a thoughtful product and brand.
Okay, perfect. And then last one from me, and I know it's really early, but was just wondering if you could provide a little bit of color on the early progress you've had with the loyalty program. Are there any early metrics you can share there?
Yeah, so we've been working on both loyalty and delivery over the past year. We're really excited about, us being able to launch it towards the end of this summer. And back to the point on the data, we feel that we're in the best position to actually roll out a best-in-class loyalty and delivery program, just given the recreational transactions that we've been able to do kind of over the last 2 years. Since 2018, we've actually done over 2 million transactions now across our retail locations in both California and Nevada. So we're really excited about the ability to roll loyalty and delivery out to our customers and create a truly omnichannel experience for them.
Awesome. Thanks, guys.
Your last question comes from the line of Jesse Pitlock from Cormark.
Hey, good evening, guys. Just to come back to the PharmaCann topic, maybe I'm incorrect, but I thought maybe originally the plan was it might close in tranches, and now it kind of sounds, if I understand you correctly, that it's probably going to close in its entirety in fiscal Q2 20. Is that correct, or is there still a chance that it might be tranched out?
No, hey, it's Adam. Let me clarify that. So as Z tried to explain, so there's two pieces of it, right? We have to get through the Department of Justice and the HSR stuff, which we are highly confident we will. And then they've given us an approval kind of at the parent company level. And then in addition to the parent company approval, we need each state to approve the transfer of the license from PharmaCann to MedMen. So you can expect this to be almost feeling like rolling closings on a state-by-state basis. But as soon as we get through the HSR stuff, we will have closed at the parent company level.
Okay, and then just to follow on that, in terms of your discussions with any of the state level regulators, if you've started them already, have you encountered any type of pushback or any hurdles so far?
No, I mean, I think the PharmaCann teams, the government affairs teams at PharmaCann and the government affairs team at MMEN have been doing a really great job. There's nothing in any of the markets that would get in the way of us, seeing through a full closing. The only state where a decision really needs to be made is New York, where there are only 10 of these licenses that currently exist, and between us and PharmaCann, we would hold 2 of them. And so the state of New York has a decision to make in that regard. We expect that decision sometime in the next 60 days.
All right, thank you. That's very helpful.
I will now turn the call back over to the presenters.
Thank you all for joining us. If you have any remaining questions, please don't hesitate to reach out to us. Thank you.
This concludes today's conference call. You may now disconnect.